Good morning. Never mind that. Let's not try to play our background music. It would be messed up out here on the copyright side. Welcome everyone to Heyward CPA Livestream, podcast, and all that. It is Saturday, May 3rd, 2025. First and foremost, we have to wish happy birthday to our esteemed colleague, and I'm messing with the headphones today, and our table setter at the firm, Nicole Cooper. She's celebrating her 21st birthday. That's what's happening right now with her. So she's in the building. Well, she's in the building somewhere celebrating. She's doing real good, and I might add, our co-host, who has a lot going on, has people in town, so he'll be in and out this episode. But I'm here and going to do the best I can to give you a riveting show behind the things we talk about: taxes, accounting, business. But today, because we weren't on last week, 2 weeks ago, weren't on, had to take the respite from the tax season. Had to get a respite. We had to get a respite. So we took 2 weeks off because that was the week of the tax deadline. So we sat that week out. So now we're here. I want to go over some things. I don't have a book of the week this week because the book of the week was the Internal Revenue Code, Title 26 of the U.S. Tax Code. So I was doing a lot of follow-up, a lot of reading on that. I want to get into some things this week on what's been happening. The weather is nice now, so I know talking about taxes is not going to be the be all the end all. It's not really going to be what you want to do right now, but we're going to talk about it today because the season just ended. So we want to see what's going on. And as you have down there, you see we are available to answer some questions. Put your questions in. We started a new website, email address, podcast at Heyward CPA, podcast at Heyward CPA, so that you can send us your questions, your comments, concerns, and all this other stuff going on. So just making sure everything is on point. Make sure we're online everywhere. Before I get into this, because this is going to be a pretty good episode, we're gonna discuss quite a few things, my friends. Quite a few things that we want to discuss from a layman's terms in terms of tax. So let's get started, okay? April 15th has come and gone. It's out of here. It is past. Some people filed their returns, made their payments, getting a refund. One way or the other, they're done. In their mind, they don't have to think about taxes till next January, roughly. Most people really February, because that's about the time that you receive the W-2s and your 1099s. So those people are done in their mind. In their mind, they're done. Okay. For those of us that extend our returns, It's not over yet. It's not a done deal. We still have some tax action going on. Good morning. Good morning. Very good. Good morning. Got the consistent fans over here. Part of our VIP club. Definitely on there. So good morning. But anyhow, those of us that extended, all we know now is we have until October to file. That's what we know. That's what everybody does. But no one really discusses what happens. What is an extension? What is it? Well, an extension, people, is an extension to file. That's what it is. So there are two parts of tax administration. And I may have gone over this before, but I'm going to go over it again because it comes up every year. There is filing the return and there's paying the tax that's due. Two parts. Two parts to the game. All right. I'm trying to get the light to get rid of these shadows, you know. But so there's two parts to the game. I'm going to say it again. Filing the return and paying the tax due. Two parts. What you do when you file the extension by itself is you have an extension to file the return. The extension gives you a file to return. It does not give you an extension, extended time to pay. Some people don't realize that, but that's what's going on. So the natural question is, why is it like that? Well, that's a great question, but I'll tell you what happens. In some cases, people are able to file, pay. You know, they pay what's due, and then when they file, they might have paid too much, so they get a refund back, so on and so forth. It goes on. I don't know the genesis of this law, but I just know that's how it works, and I know that your extension does not give you an extension to pay. So if you owe money, you will begin to be charged penalties. And interest will accrue. So that's that's what an extension does. The next point is, well, what are the penalties? So the penalties are 0.5% per month. And it's called the failure to pay penalty. So that's what you're trying to, the max. So the max it will be is 25% of the tax due. So it's 0.5%, folks, per month. 0.5%. So if you take the time that most of us, you file is 6 months, so it'll be 3%. That's the failure to file. The failure to pay penalty. Now, the reason we do file the extensions is because there also is a failure to file penalty. Let me reset this, okay? Failure to file penalty and a failure to pay penalty, just like you file the return and you pay the taxes. So there's two levels here of penalty. What you want to do is file the return. No need to pay a penalty on failure to file. There's no reason whatsoever. None at all. I mean, it doesn't cost anything. You put it in. No need to do that. Now, failure to pay, as I said, is 0.5% per month. Failure to file is the same, by the way. But failure to pay is 0.5% per month with a maximum of 25%. So that means you need a lot of months not to pay this tax for 25%. And it happens, sometimes, I guess it would be like 50 months, almost 4 years. Then you get that for the maximum penalty. But it's 0.5%, folks, 0.5%. So, and then, I mean, it becomes money. But I mean, if you owe $3,000 or something like that, it's like $150. You know, and I say it to the point that people get really uptight when they have to extend, and they're worried because the term penalty scares people. But it's 0.5%. If you don't have the money, I mean, you don't have the money. Hey, you didn't pay it before the due date. Okay. So, but these are the repercussions of what you have, 0.5%. So that's what's going on. So this is what happens with this extension. Now, you have 6 months from the due date to file the return. Well, okay. And then most people usually wait till October to handle it. But remember, the clock is running on this failure to pay. And even though I said it's nominal amounts, still the 0.5% could buy you, well, it can't buy eggs anymore, but I don't know what it could buy you. But that 0.5% of what you might owe can buy you something. So it's in best interest to go ahead and get it filed and get it, you know, and get it paid, even if you get an installment agreement. There's a lot of ways to work with the IRS in paying your bill. In some cases, they give a grace if you file. It's a short-term grace if you pay it like in 30 days. They have installment agreements. They have more complex installment agreements that you have to do based on your balance. But in practice, we find that filing it and paying it and dealing with it is you know, what you need to do. Now, because and most importantly, if you're in a state that taxes you, they get you first. They will get to you before the feds. The feds take a while to kind of get at you. But remember, as you may or may not know, I say all the time, our goal is for them to leave us alone. That's what we want to do. We want to file, render to Caesar what's Caesar's, and have them leave us alone so we can do what we want with the rest. So that's, you know, that's kind of the environment why you want to go ahead and get things, you know, that's the flow of what's happening. You know, for we filed the extension, now we want to go deal with the payment. Okay. So now, here we go. What happens if you didn't file extension? Good question. You forgot, you didn't know, maybe something happened. Maybe you had a personal event happen. That could have happened. All right. So you didn't file an extension, didn't pay, you didn't do anything. Okay, that's where the 0.5% per month. And mind you, all this stuff is if you owe. If you're getting a refund, there's no penalties if you're getting a refund. Think about it. They're not going to charge you a penalty for collecting money from them. They're not worried about that. In fact, they're like, hey, take your time. Take 3 years, because after 3 years, you can't get the money. So take your time. Another reason you should file, especially if you do refunds. So this is for people that would owe money. So if you didn't file, the thing is to get, if you can't file an extension after the due date, you have to file it when you know, by the due date. That's the whole point. So you're late. So you have 0.5% per month. Best thing is go ahead and get it done. Go get it in. Even if you can't pay it when you get it done late, you're starving off certain, you know, you're saving some money in the penalty, because now you're going up to a full percent. If you didn't file, you didn't pay it, now you owe 1% per month on it. So, you know, I mean, it's according to what you owe. I mean, it's all money. Some people might say it's real money on a certain level. You know, what you need to do, but make sure you file it. So, as I said, understand what an extension is doing. Okay, understand what's happening there. We got we got a question here. What do I think about tax abatement? Well, federally speaking, most times there's penalty abatement. You can get certain penalties. Some of these penalties, you can get abatements. I'm not here to tell you how and, oh, sign up for my deal for $39.99 and I'll make your taxes disappear. We're not doing none of that. What's happening is that there are legitimate ways for you to get penalties abatement. Tax abatements usually I see more so in real estate tax, personal tax for certain groups of people. They get a tax abatement, and certain more local taxes. Federal, there's some provisions, but they're very specified, very unique. But I know there are provisions for doing penalty abatements in on federal tax returns. So that's that. So this is what happened. We filed that. All right. So if you didn't file your return and you didn't file an extension, get to it. You might want to get to it. You need some help, give us a call. Or actually go to our website, heywardcpa.com. That's the best way to get in touch with us for our world-class tax preparation process. You want to be a part of it, come get it. So come do that. All right. So but that's that. That's where we go there. Now the next thing that I wanted to cover, because this is and send your questions in. Send your questions in if you had it. I'm right here. This is live. I'm answering tax questions online. I mean, as I said, we are a full service CPA firm. I am licensed by 2 states to practice. I'm not going to tell you how to make taxes disappear. Some people try to tell you. Like, taking your family on vacation and calling it a business trip. I'm not going to tell you to do that because you can't. So you can't just take your family. Anyway, I'm not getting into that. That's not what we're here. We're here for enlightenment today. I do want to give some information, some insights that are happening with the taxes out here. Now, I want everyone to understand how taxes are calculated. Taxes are calculated. Well, the actual tax is computed based on tax brackets. So when you hear people say they're in a tax bracket, they people will say I'm in the, well, most people don't know what tax bracket is, but let's just say I'm in the 22% tax bracket. What that means is that your highest dollar amount is taxed at 22%. It does not mean that every dollar you made that's taxable is taxed at 22%. It means that, so if you made $100,000, I do not have this committed to memory, but there's a portion of it that's taxed at 10%, another portion that's taxed at 12%, another portion that's taxed at 15%, and the top portion is taxed at 22%. That's what it means. So it's a blended rate when you get down to it. It does not mean that I made $100,000 and I'm gonna pay $22,000, or I'm gonna owe $22,000 in taxes, or I'm responsible for $22,000 in taxes. It means that you're getting a piece of all those sections there. So that's how these things work. That's understanding that we have rates. We don't have, it's not flat. Now, so be careful, because those of you that believe in a flat tax, some people seem to think that might be the answer to ease their taxes. Well, I don't know. It's all according to what that flat rate will be, but I'm pretty sure that's never going to happen. So I just don't see that happening. Personal opinion. So that, we can talk about I'll talk about tax reform towards the end of this, but understand how this stuff works. So it's a blended rate. So when you get to your effective tax rate, which is basically the amount of tax you paid against your adjusted gross income or your taxable income, it's usually pretty low as a percent. You know, you'll see people as a percent of what they made, you know, 12%, 18%, but their top bracket might be 25. But when you take out deductions and some of these other things, and well, that you're actually paying 18% of what you made. Sometimes even lower. Like I said, someone with $100,000, I've seen, you know, people $100,000 paying like 12% effective rate plus the state rate. It's better. Obviously, zero is the best, but there's only way. The main way to get to zero is to not make any money. But 12%, you know, so it's all in perspective when you look at it. Or you kept 88% of your money. You paid 12% tax. You kept 88%. I don't know. It's one way to look at it. I mean, it's up to you. I don't know, but I'm just saying. But anyway, the lowest tax rate is 10%. The highest tax rate is 37% of one of those brackets, of those buckets. 10, 12, 15, 22, 25, 37, something like that. So it's 7 of them. I do not pretend to memorize these things because I always know where to go ahead and get them. Oh, got our man up in here. So now I say I can put you on blast. But wait, let me finish this section, and then we'll get to you. You know what I'm saying, in the section. So that's what we have going on. We have, I kind of like this. So we have, those are the rates. So that's one thing I want people to understand. The other thing I want people to understand is deduction. Okay. What can I deduct? Probably one of the number one asked questions we get. What can I deduct to reduce my taxes? Well, let me give you a little briefing here. The Tax Cut and Jobs Act, also known as the Jobs Act of 2017, changed the way certain things are calculated. And what it did was it increased the standard deduction. And it removed exemptions from tax returns. So what does that mean to regular people? It meant that, in theory, you no longer were claiming somebody. You know, people were like, I'm claiming so-and-so. I mean, you could claim them for your status, but you weren't getting a direct dollar amount for having that dependent or for being married and all this other stuff. So they took that away. But what they did is they boosted up the standard deductions. And standard deductions are the deductions that you don't have to document. They say, hey, we'll give you a standard. You probably didn't spend anywhere close to this dollar amount on the items that are deductible, which are state and local taxes, medical, charitable contributions, and there's a mortgage interest, and there's others. We're just saying in general, from based on our research, hey, if you're single, like for instance, I think I looked at the 24 numbers, 14,600 if you're a single person. All that stuff right there, we're saying you spent 14,600. You don't have to prove it out to us. No problem. Take it. Run with it. Okay. If you're married, it's double that. 29,200. We're giving you credit for spending 29,200 on medical deductions, local taxes, including property and real estate taxes, even though there's a cap on the real estate taxes for those of us in those high tax states, especially in the Northeast. 10,000, the most you could get for that anyway. Charitable donations, charitable contributions, mortgage interest, and then some other things. 29,200. I don't need one sheet of paper, which means the practitioner doesn't need one sheet of paper. I don't need none of that. giving you credit for $29,200. And it's made an effect. I saw it over 7 years. It's kind of made an effect. It's made a difference. Saw that. So most people are getting a standard deduction. I mean, that's what's happening. Most people are taking a standard deduction, unless, of course, the combination of those items I just said exceed the limits. So if you spent more than $29,200 as a married couple on, I'm going to say it again, medical expenses, state and local taxes, which include real estate taxes, charitable contributions, and mortgage interest. So if you spent more than $29,000 on that, then you get to itemize. If you did not, as a married couple, you can itemize, but it's not going to have a benefit for you. So, man, wow, interesting. Also, it's very interesting because we've been, especially through COVID, we've been in an environment where interest rates got down to 3%. So guess what? If you refi or something like that, I mean, heck, if you were at 5% or something, a lot of us, a great deal of us, have very low interest mortgages. Now, that's subjective, of course, but the interest is low. So that used to be something that would activate the itemized deductions. I mean, here we having a tax increase here where I live. It's a little sticker shock, but I have nothing to complain with those that live in the Northeast. They're paying way more in taxes, but still, theirs is capped at 10. So what I'm trying to paint the picture here is that the standard deduction has made it, most people are getting, they're taking standard deduction. So when you ask what I can deduct, I mean, you can give a whole lot of money away to raise it up. I mean, it's fine places. So it's like, what can you deduct? So anyway, the big, also they increased the child tax credit too. The Jobs Act increased the child tax credit to $2,000. I think it's up to 3 children. So, and $1,400 of that is refundable. So what that means, it's a refundable credit. That means that if all the math comes around and you don't owe any money or you paid enough to cover, that credit can be sent back to you. It counts as you paying money. So you get up to $1,400 of that credit sent back to you, like in your pocket. It goes there for you. So what's the big whoop? The big whoop is it expires after this year. Most of those provisions expire. The individual provisions are out of here this year. So this is where the politics comes in. We don't know. We have no idea what's going to happen. Like, none. I'm not going to sit here and tell you I know what's going to happen. The way things are constituted, it looks like things will be extended. But some of the other activities that have been going on, then there's going to be additional cuts in there, I'm sure. That's the way it's looking. So those of us in the profession, we have to prepare for it as written. And we'll see, what's going to happen. But I'm just here to explain. These are the insights, what's going on. This is how things happen when people are saying, well, man, I don't know, what can I deduct? Well, it's challenging to get over the standard deduction rates. It's challenging. I'm not saying we've had a few, but the percentage of people whose deductions that I named, those categories, exceed the standard is low. I mean, it's lower. Definitely before this act, it used to be more, but now it's lower. So That's that. And there's the final note on this section. And remember how I was talking about the buckets of tax? You know, you got 10%, 12%, 15, 22, 27, 27. I don't know. Like I said, I don't have them memorized. But what I will say is that most of the clients that we've seen, their bucket stopped at between 12 and 24%. So that tells you what kind of friends we have. You know, we don't have. I mean, we might have one or two 37% friends. I don't think we might have had one, but yeah, I think we might have had one, maybe one 37% friend. But other than that, 12 to 24, and that means. But remember, the effective tax rate is going to be less. So you know, it's just to make you feel better about yourself. But anyway, so that's my diatribe. So yeah, my man, you came in right on time. So you know you're in the building, you're here. So now I can make the second special announcement that I wanted to get. You're in the building. You're in the building. So can you hear us?
Oh, 100%.
Oh, okay. You in here. So look, I was starting it off. I want to say, and this is perfect at the bottom of the hour here. We also have to recognize.
By the way, you're great. You're a great orator, facilitator, communicator. Your timing is impeccable. You do great shows. You're so melancholy. You're very ground surface.
This is called a preemptive strike.
You know what I'm saying? Like,
it's called a preemptive strike, man.
Your performance and the methodology behind your performance is astute.
Man. Oh my
goodness. You know what I'm saying?
The gas has moved up to $8 a gallon. This is out of control here. That's what, ladies and gentlemen, you call a preemptive strike. Because all I was going to do was say that this gentleman here is, since we won't be on before then, he has a birthday coming up in 2 days. And that's all we were trying to do was get a little happy birthday going on here. And you know, you know, happy birthday. You know what I'm saying? That's all we had going on. But he gave the preemptive strike to try to keep me from gassing them up. See, y'all, you know, you gotta know your people. I know what that was. So that's it. So, you know, I've been yapping, man. I've been yapping you know, about taxes, the most exciting thing in people's lives. I mean, it is for me, but I mean, other people, you know, they ain't on it. So, what's going on? I mean, let's talking about your birthday is way more interesting. Coming up, you got a big one coming up. You know what I'm saying? Like, you're hitting the gateway. Like, you coming through the door, the clan coming through. You know what I'm saying? You got the kick in the door flavor. You know what I'm saying? Like,
well, waving the 4-4, you know?
Yep. So you coming into a new decade. So I don't even have to say the age. You just come into a new decade. So that's that, you know. So you have any words of wisdom for our listeners?
Occam Razor.
Oh man, yeah, here we go, man. I can't see. All right. Right. I'm going back to taxes, yo. Right there.
Oh man, let me tell you something.
Razor. Oh,
Occam Razor. That means the solution is the solution.
Tis what
the answer is the answer. You don't need to find anything alternative.
That's right.
You know what I mean?
It's a way of life.
Yeah. No, it's been a long journey, you know, to this number. That never most of us don't think about getting to that number. You know. We just trying to be here seasons. Daily, weekly, monthly, and seasonally, right? So
this guy. Yeah, I'm gonna put my man here. This is my man. He every year He like 2 years. I guess he's your age. I don't know. He always like, yeah, my age. Like I was like 5 years older than him. So I'm like, dude, you like 3 years, y'all. Yeah, so you our age now. So that's what's coming in. So well, it's a celebration though. It's a celebration. I mean,
yeah, I'm trying. You know, I'm taking it one step at a time. I'm appreciating every second of it every day up until, because I know once that door opens, I mean, the other door closes behind me and going back.
yeah,
You
you
know,
really gonna appreciate every day after that.
exactly, right.
Those
So,
new
you know,
aches and pains. You're like, yo, what's this? What's going on, man? Yeah,
so
so
this next decade this next decade is actually attributed or contributed to the following decade.
yeah, it's a prep. So you
Yeah,
can be on that golden sail. You can be like, yeah,
yeah,
everything is good. Everything
yeah,
is good out here, you know.
exactly.
Well, that's very good. That's very good.
All good.
So
It's
we
all good.
glad to hear. We did
And at the same time, I do want to say, so I do have I guess my best gift is little Kory graduating college this week.
that's wonderful. That's wonderful. Choice of schools, suspect, but he finished.
You
So,
know, I mean, you know, his A1 choice,
I know
which
they didn't
was
come up with the bread. I know.
so,
Yeah, I
you
get
know,
it.
so they questionable. It wasn't his loyalty, it was their loyalty.
Yeah, so I mean, I understand, but it works out for the best. So
True,
I think it worked out for him.
true.
I think it seems like it worked pretty good for him.
Based
But
on the journey, right? Yeah,
yeah,
absolutely.
I think it works out, man. But that little thing is all about cousins anyway. I tell people anyway, the students are the same.
Right,
Like literally for real. Like
right.
it's like cousin sibling rivalry or cousin rivalry. Like I'm like that's a whole nother story. But shout out to a lot of graduates going on this weekend. Next weekend. Next weekend. My niece is graduating from ECU next weekend.
Nice.
So any other graduates I know? I don't know. People just out here graduating, man. That people matriculating and graduating. Oh, my man. Actually, I think my man Kyle. I gotta check on him. He might be. I don't want to call nobody out if they not graduating. You know what I'm saying? Like something happened. So I don't want to say anything right now. But But congratulations to all the graduates. I will say, here's my graduation speech. I even get called a commencement speech. I will say that things are never as bad as they say, and they're always better than I haven't worked this out yet, but it's just that what I was getting at is that there's a lot of talk. All the talk is, oh, these kids got debt, they can't get jobs, they can't this, they can't that. That's media talk. I mean, you know, if that was the case, why don't they just close the schools, dude? You know what I'm saying? We have a population thing. The baby boomers are hitting retirement age now. So it's opening stuff up, but then technology and ingenuity is reducing the types of jobs that have to be there. Entrepreneurship is available to more people now. Entrepreneurship on a mid to higher level. It's always been proprietors who made their bread on their own. So, I would say, hey, looking back, man, that was a long time ago when I did that. But anyway, looking back, man, it's like they have a whole different world. Like you think about it when they get our age. I mean, like for real, the car's probably gonna be flying for real. Like
Well,
for
they
real.
flying now, somewhat flying.
Yeah.
But
But I
yeah,
mean,
you're right.
I'm talking Jetsons, like for real.
hmm
Like,
Back to the Future skateboard flying.
yeah, like so, this is so what is has always been, and what
What
will
will
be
be
shall
will always be.
yeah, like so there's always opportunity. And even though, I mean, we're if you listen to media, we're in the dark ages. Certain media, we're in the day of life. You know, like we're in the golden age. One outlet says the golden age, one outlet says the stone ages. So the truth is always in the middle. So that's good though. That's good. So yeah, that's all right there. So that's oh, so what was his major?
Sports medicine. So he's doing what's that? Orthopedics.
Mm-hmm. Pretty good place to be.
So he's getting ready to go to med school. So gearing up for that.
Yeah, he's smart. He's smart.
Man, listen, he got to buy his father a baby yacht. What you mean?
Why baby? Just get a yacht.
I don't need a big yacht. Because then I'm gonna need more people to fill it up. I don't need people.
Like you can live on it. I should be like, yeah, I'm on the yacht, yo. I'm good. My residence yacht. You know what I'm saying? Like that's
because see how my family dynamic is set up. If I have more room, they gonna come and not leave.
Don't come to the dock unless they got helicopters.
I'm just thinking if I got a big yacht, they gonna come in. Most of them, they ain't gonna want to leave.
I know.
I love my family to death, man, but I like my peace of mind too.
That's big, yeah, man. You might have a little small joint that comes out, it detaches, and then you can roll out.
I ain't running from my yacht. I'm staying on that bad boy. We can have a day party. We can go out fishing, do what we do. There's enough room for everybody. If everybody won't fall asleep, it's cool, but not staying.
Not staying. Absolutely. Got to go. You ain't got to go home, but you got to get off this ship. That's it. Next port is over for you. So anyway, so that's it. That's good stuff right there. So we see, we broke it up a little something. We went tax. Now, I'm still not done with tax, but we went tax. Got a little stuff going on. Seeing the positivity in the world. Young people graduating from school, entering the adult world.
Oh, we got to give a congratulations and appreciation shout out to the parents that hung in there with their students going through school
and paid.
And paying.
Paid and paid. I mean, even if you didn't pay tuition, you
paid
something.
Some money.
You sent the child.
You might have paid in some stress. You might have paid in some stress too.
Stress, food,
right.
Yeah,
water bill because you got to watch they come to watch.
That's exactly what I was about to say. Laundry, So no, but the graduation is a celebration. It's a celebration of the whole families. I think in this area it could get taken for granted because we have so many universities, so that everybody that. But it's a big deal. I mean, it really is. When you get it, and I think we don't do enough to celebrate ourselves, just in general. It's a big deal. Graduating from college, So I think I got another whole. I got a bunch of people. Like I said, I don't want to call them out because you never know what the situation. Oh, actually, Stephanie and Tanya went to Stephanie's daughter. She graduated from her master's program out in Tennessee.
Congratulations.
Yeah, she is there. So she's about to be. She's like in that same field, physical therapy or something like that. She's going to come do a residency. Back here. She's coming back here to do that. So this is big. It's big out here. It's going on. And we're here. I'm doing taxes. So I got going on. It's sorry. But that's what you came here for.
And business therapy, business development.
Yeah, but that's more interesting. That's more interesting than taxes. It is. Let's just be
you think? Well,
it is.
No, it's got its. So there's the undertone to taxes, right? That we talk about a lot, and the undertone is the clarification and the understanding of what people know. what they hear and what people tell them it should be. Right?
Mm-hmm.
Okay. Yeah. Business is the same way. Just because you have an LLC, an EIN, you selling something doesn't make you a CEO.
Oh,
Doesn't make you doesn't make you all 7 phases, even though you're managing all 7 phases of the business, doesn't make you the 7 phases of the business.
No, right? It doesn't.
Right. But, so there are those that are committed to the process. And then there are those that when they come face to face with themselves, that's when you're gonna find out who you really are and if they really committed to the process.
Yeah, but see, taxes are like dictated. It looks like there's a mandate, so it looks like I have to do it. Yeah, it's like a root canal. Whereas, there's portions of being a business owner that are like root canals, but people just ignore them. Like that's so they just say, oh, I was supposed to do that. Oh, I don't have time to do that. Oh, I'm like that. So what you do, but I mean, it's good because what you do, it's a little more like pastry,
Oh, I definitely enjoy it. I have fun with it, right? And get to move the needle and see people progress, which is a great thing.
Taxes are more like raisins. They have some sweetness. But they're basically
like a box of chocolates. You don't know they're dried up what?
They dried up grapes. I mean, that's what raisins are.
Right.
Shriveled up grapes. That's the way I look at it. So, but I mean, but you don't have to eat raisins, but you need to get what I'm trying to say in contrast.
Understood.
Well, what I'm saying here is though, but I just did in my agenda, the final section that I had to cover was about planning. So so I'm just going to recap because, come back in, we're talking about what happens with extensions, what happens? What do we need to do? What happens if I don't pay? What happens if I don't file an extension? We covered that. This is available. The recording is available on our YouTube channel. In case you missed it, you go back and watch at the beginning. Some insights, understanding taxes, understanding what's happening, understanding the tax brackets. Remember, there's buckets of taxes. There's buckets, little buckets like that. Understanding deductions, standard deduction, the challenge. Oh, I also want to talk about those non-cash deductions. Now, quickly, the non-cash deductions, if you're giving away a sweatshirt you had since like 19, just insert 19, say 19, whatever, you cannot, it's prudent not to value it at the retail equivalent of today. We had it 30 years, let it go. But anyway, non-cash deductions takes a lot to get those over there. But yeah, it takes a lot to move from the standard deduction to itemized deductions. And most of us, the standard is more than enough. And we also, we talked about the brackets. So now let's get to plan. Like, what do I do? What do I do? Well, if you're a wage earner and you owe, this is primarily if you owe. No, this is if you owe. What you want to do, and you're a wage earner, and you're like, oh, you're having a hard time, I owe every year. What do I do? The first thing we tell you is to check your W-4, increase your withholdings from your check. And the reason that is because it may be difficult for you to create a habit of putting aside the monies that you need to owe. I mean, most people I need my check, I need my paycheck, I need it as is, I'm struggling as it is. Well, one way you do it is, you reduce the paycheck, send the money to the government, You in the building. That's one way to reduce it. If not, make estimated payments. Now, something that I think about, and I've suggested to a few people, is make the taxes like a bill. We used to bills, so people get wrapped up in the quarterly payments, but there's nothing preventing you from making a monthly payment. It's just there's some other regulations, other laws that say it's checked at the quarters. But say you owed $1,200 last year, and you like, yo, I ain't with that no more. So I don't put $100 a month. You can send it to the IRS, $100 a month. Boom. You know what I'm saying? So for your quarter, you know, boom, you got your 300 in there for that quarter. But that's your cash flow. This is the secret. One of the secrets that I think causes people problems with taxes is cash flow. Because the tax events are, well, they're events. They're annual in most people's minds. So because of the passive nature of money's being taken out their check, it becomes, people don't think about it. They're like, oh. And so then they're like, oh, we're going to sum up at the end of the year. And you knew you owed last year, right? You know, and if certain reasons you don't have to make estimates, so on and so forth, but whatever. But you know you're going to owe next year. So you can put the money on the side, or you can go ahead and pay it in. Pay how your money goes. If it makes sense for you to be like, I need a bill, it's better for me to say, man, I pay my bills like this. I pay every month. So you take the money out your hand. Let's just be real. Some people got to keep the money out their hand. Like, let's be real. Some people are on fire. Some people, the money hits their hands, it's gone. Like, that's it. That's what happens. Thank you. So you know, you put it away. I mean, if you super slick, you go put it somewhere and invest it, pick up a little interest, maybe some dividends for the year, and pay it off. If you discipline it, probably not. Calm down, children. That's probably not happening with most people. But that's how you do it. But I think the biggest thing is saying, if you owe, I mean, you know, you get on a payment arrangement. If you're self-employed or you have the real deal is if you have a side hustle. That's what always jams people up. They got yeah, see, they got a side hustle. They make good money or whatever. Then they have this thing on the side, and it's starting to pick up. And they're like, oh, I know I'm gonna have to pay taxes on it. So they start flipping out, and they come to us in February, and then, you know, with the cardinal, the sin of giving us a box of receipts. And I say, you play sound for that. I say, oh, no. Yeah, I was like, do not bring that to me. You either gonna fill out this form with your categories, or let's go ahead and get you set up on some bookkeeping. But that's usually what causes a problem. Some people
on BYOB, we set you up on BYOB. Let's be a little specific, so we can get you current and move you forward, right? So there's a solution to these things.
Oh yeah, right? Well, I was gonna roll into the commercial at the end of it.
Occam Razor.
Yeah, so that's why I was going to be like, you know, I don't want to push anyone somewhere they don't want to be. So the point is, so you know, but the cash flow implication of taxes is something you must pay attention to, folks, because for some people it's easier to pay $450 a month rather than $5,400 at one time. You know, that's what we have to do, and you have to think about that. You have to create disciplines. I don't think did I mention it? Oh, yeah. I mean, last week when I was speaking at the Thriving Faith financial boot camp, I was talking about taxes. I started talking about emotions and stuff, all other types of stuff. But anyway, it's what I do. It's a case where, hey, look, gotta separate your emotions from your money. Number one. And that's how you can build discipline. You have to build discipline. So taxes are just one thing. I started it there. And when I said, look, taxes, if you look at a financial statement, and take your favorite business, go pull their annual report. This is like if you have absolutely nothing to do with your life. Go pull your annual report. Go look at their income statement, and the taxes are at the bottom. But every small business owner that we meet usually comes in talking about the taxes at the top. And I'm like, they don't calculate taxes at the top, people. Even wage earners, they don't calculate at the top. They just take it out because they know. Could you imagine if everybody got their whole check, and then they would have to so everyone would owe. Could you imagine? It would be chaos. It would be ridiculous. Everybody owed money.
True.
So the IRS would have to be the draconian organization that everyone thinks it is, because they literally probably had to come to your house like, hey man, we need to get that. So but it's about cash flow. And remember, I'm linking this back to what I said, the effective tax rates as a percent. I've had people, they've gone crazy. I owe this amount of money. And then I'm like, well, is this percent of what you brought in? Now, I'm not saying they're happy about it at the end, but it's like you got to put it in perspective. So if you think about it, you say, oh, well, I don't make enough money. They taking all this money, whatever. So if we use percentages, this is basic math, and your salary is 100%. Your taxes accounted for 15%. That leaves you at 85%. But the chances are you living on 105%. Well, actually 125%, probably like that. But so it's easy to attack the taxes. Very easy. I'm here all week. Very simple. I mean, it's easy to tax that.
True.
Spending habits? Nah, not so much. Because as I stated in this workshop, I said saving money is the least in the United States. Saving money is the most unnatural financial function you can have. Mm-hmm. There is nothing about our society that encourages saving money. Since we got off the gold standard and they don't even need our money in the banks. People don't saving. What? No. I need the dopamine hit of spending so I can get up and go to this crappy job on Monday. That's did I say that out loud? My bad. But anyway, but I'm just saying this is how it works. Our entire society is about spending. Spend your money, but save for retirement. But spend all your money.
Right.
I save for retirement. Right. Oh, you know what? Spend all your money, save for retirement, and save enough money to buy a house.
Right.
Just need a down payment. We'll get you a low down payment. We'll get you the mortgage for the rest. All right. So your payment will be a little bit higher, but you still got to save your money. Okay. Saving money, saving retirement, buy the house. Guess what? Low APR on the 2025 insert vehicle. That now we're going to finance you over 84 months. They're going to say that quick. 7 years for a car. There is nothing. Not only that, I could say you could go on a cruise for $300, where they're going to upsell you the whole cruise. So tell me, where is the saving? Who the heck? Saving is not natural. In the DNA of the average American, all of us, is to buy stuff. Some of us buy Temu. Some of us buy Louis Vuitton. Some of us, we buy. So you have to build mindfulness to be like, pump the brakes. I ain't gonna buy it. I mean, I honestly believe you do have to, because I do it. Sometimes I'm like, yeah, I'm gonna go get, man, I don't need that. I have to do it because I'm just like, man, especially since I buy cheap stuff. Oh, inexpensive. I buy the things that I buy are like, if they're not if they're not electronics, they're like, I just buy them, Yeah, I buy that. I buy that. But I mean, I was just saying, like for instance, I was at Home Depot yesterday, and you're like, ooh, the weather's nice. You go, I'm like, oh man, I could go do. Yeah, I need this for the house, that for the house. Man, you ain't about to do none of that. Just let it sit right there. So you ready to take on a project. Ooh, it's a dopamine hit. Like, oh yeah, feeling good. Man, I haven't worked in my yard in a long time, and I have no intentions of it. So I'm gonna play myself. But it's easy to go ahead. I got a Home Depot card. I could be like, yeah, I need so and so. Boom, a patio set, a grill. I want a grill.
Yeah, but you got aspirations for your yard though. So
yeah, somebody gonna do it.
At least more now. A lot more now than anything else, right? So
yeah, but what I'm saying is that the impulsive spending is in play.
Understood.
So
I was just addressing your I ain't thinking about my yard comment,
No, I said I haven't been working in the yard. I was like, no, I'm thinking about it. I'm thinking about it hard. If I said that, I misspoke. I'm sorry. I said, yeah, I'm thinking about it seriously, but it's me saying no. So anyway, that's my thing. How that goes back to taxes is like, yes, if you want taxes to be the enemy, it'll be your enemy. Taxes is just something that you got to do, like taking your vitamins. It'll be just that.
Would you say the appropriate thing? Would you say the appropriate thing is for people to learn how to do budgets and do a monthly budget for themselves, a weekly budget, bi-weekly budget, depending on their payment frequency, bill frequency, to help them be a little bit more aware outside of you suggesting it be a monthly bill, but knowing what you're spending. Because sometimes once you break $100 bill, it's a wrap. Once you break a $20 bill, it's a wrap.
It's a wrap, yeah.
And then because it's digital now, you can just swipe it and there's no physical,
Yeah. Absolutely. I mean, I think we do a whole show on, but we need to bring somebody in here to talk about budgeting. We need, and that's what these financial planners and financial advisors can assist you with. You have to budget. Because no matter how much if you have a job, you got fixed income. Like, people don't think about that. This is fixed income. People on public assistance. Well, no, if you got a job and you make X a year, unless you get bonuses or you're commission based. Oh, look at the king. Look, yo, the king, you over there celebrating. Look, he keeps disappearing. Look at King. King on a real fixed income. His income is real fixed. It's all good. But you on fixed income. So you got a fixed income. But your expenses are not fixed because you do whatever, buy whatever. It is what it is. So with that being said, we have that, the king was up in there. King was
trying to get low. I'm trying to get Lola. Come here, Lola.
Oh yeah, we got another special because there's a party this weekend.
Come here, Lola. I'm trying to coax her with my
hold up. How you gonna get up? You can't.
Oh yeah, she jumps in my chair. Come here, Lola.
That's right. She's shy now because the camera's on.
Oh, I'm about to get her. Hold on.
Yeah, so we rounded out. I know this was a lot of stuff, but we rounded out with the K9 corner. My guy, he's not really trying to be up in here right now. Yeah, see, that's what I'm saying. This is look at that. Yeah, that's serious beef right there. I tell you, see, you can't just pick her up. Lola, How you doing? She's like, yeah, that's a puppy. So King is old school.
She's a puppy. She's
old.
King is old. She's a year and 6 months.
Yeah, so we see what you got going on for the birthday there. You got your 2 fans over there. Hey, I'm good. This has been an interesting episode. Wonderful, wonderful, wonderful. So we get ready to transform and roll out.
No doubt.
You know what I'm saying? As I said, you see in the scroll down there, we had the new email, podcast@heywardcpa.com. So if you want
hit us up.
Yeah, or if you have a suggestion for someone we should interview, send that over. You know somebody, you got a friend, and guess what? We don't even charge a booking fee. Like some people charge booking fees. That's like you gotta fill out all right, I'm just gonna shut up. Anyway, you got it. So anyway, subscribe to the YouTube channel. The additional content is being worked on right now. We have a lot of shorts on there too. So check that out. So check out the YouTube channel. Things coming up. We'll be here. Biz Therapy is a major sponsor of the Beyond Next podcast, which you also can watch that. We had a good discussion. Was that this week?
No, that was last week.
That was last week. Yeah, I had a good discussion there. Had a very good discussion about business plans. It was very, very good with our man Marcus Fryer and the Bernie Mac.
The Leonard Brooks.
The Bernie Mac of financial planning. But wow. And so all that, and then look for the BYOB content coming up on the channel soon. Gotta do some videos for y'all. Gotta get these books going. So we on. So with that being said, you know how we roll. We went a little bit over to celebrate the birthday of both Nicole and I can't trigger it the way I want to. That's right. I'm gonna have something. Well, I'm gonna be triggering sounds. Don't worry about that. Anyway, we are out. Deuce to everyone. Peace out.